Yeah, so with the 1031 exchange, what that is, the 1031 is a code section of the Internal Revenue Codes. So it's basically a law that what it does, it allows you to take advantage of the equity you have on a property. And let's say you bought a house for $100,000 and now it's worth 500, and you want to purchase a new property, but you don't want to pay the tax. So the idea of the 1031 is that you get to defer the gain. So if you sell your property and you do a 1031 exchange, you get to use all the funds from those proceeds, and it won't be wasted on paying, the tax. So you'd have the full portion of the gain to reinvest in another property. And the intention is so that people reinvest in real estate and continue to grow their investments. And the way it works is you can't receive any of the money from the transaction. You got to put it in a 1031 escrow with a qualified escrow agent. And you have 45 days from the time that you sell your property to identify the replacement property. And you have another 180 days, and the 45 and the 180 run together, but you have 180 days to finish the transaction, meaning you sell your property, you identify a property within 45 days to replace it, and then you sell or you close on the new property within 180 days from the date you sold. Okay, and with that you get to really save on paying the tax until you finally sell the second property and you decide to cash out and take the money. If you do receive a portion of the money from the transaction, that's called the boot, and that would be subject to tax.